Recent analyses have heightened concerns about the U.S. economy, with Goldman Sachs increasing the probability of a recession within the next year from 20% to 35%. Similarly, J.P. Morgan has raised the likelihood of a global recession by the end of 2025 to 40%. The International Monetary Fund, IMF, has also warned of slowing global growth due to rising interest rates and geopolitical tensions. These projections underscore the importance of recognizing early indicators of economic downturns and implementing strategies to safeguard our finances before it's too late. First, what exactly is a recession? A recession is characterized by a significant decline in economic activity across multiple sectors, typically lasting more than a few months. Economists define a recession as 2 consecutive quarters of negative gross domestic product growth. However, other warning signs often appear before official data confirms a recession. These include rising unemployment rates, falling consumer spending, declining industrial production, and an overall contraction in business activity. While recessions are a natural part of economic cycles, their impact can be severe, leading to job losses, reduced investment returns, and financial instability. The 2008 Great Recession, for example, led to an unemployment rate of 10% in the US, a 50% drop in the stock market, and a foreclosure crisis that displaced millions of homeowners. Understanding how to detect and prepare for a potential downturn can help minimize financial damage and create opportunities for long-term stability. So, what are the early warning signs of a recession? Stock market volatility and declining investor confidence. The stock market often reacts before the broader economy does. Increased market volatility, especially in key indices like the S&P 500 and Dow Jones, can indicate uncertainty and fear among investors. A sustained decline in stock prices can suggest that companies expect lower profits and reduced consumer demand. In past recessions, stock market corrections of 10% or more have preceded economic downturns by months, giving investors an early warning sign. Declining consumer confidence and spending. Consumer confidence is a crucial driver of economic growth. When people feel optimistic about their job security and financial situation, they spend more on goods and services. However, when confidence declines, spending habits change, leading to reduced retail sales, lower business revenues, and eventually job cuts. For example, in early 2025, the Conference Board's Consumer Confidence Index fell to its lowest level in over a decade, signaling growing concerns about inflation, interest rates, and economic stability. Rising unemployment rates. A sudden increase in unemployment claims is a strong indicator that businesses are struggling and preparing for leaner times. While a slight rise in unemployment can be normal, a sustained upward trend often signals deeper economic troubles. Layoffs in key industries such as technology, finance, and manufacturing can ripple across the economy, leading to further reductions in consumer spending and investment. Inverted yield curve. Historically, an inverted yield curve, when short-term interest rates exceed long-term rates, has been one of the most reliable recession indicators. This phenomenon suggests that investors expect economic conditions to worsen, leading them to seek safer, long-term investments such as government bonds. Since 1955, every U.S. recession has been preceded by an inverted yield curve within 6 to 24 months. Tightening credit markets and rising debt defaults. During economic slowdowns, banks and financial institutions become more cautious about lending. If businesses and consumers find it harder to obtain credit, economic activity slows down, leading to reduced investments and spending. Additionally, rising delinquency rates on auto loans, mortgages, and credit cards can signal that people are struggling to keep up with debt obligations, a common precursor to recessions. Now, how do you protect your finances during a recession? strengthen your emergency fund. Financial experts recommend having at least 3 to 6 months' worth of living expenses saved in an easily accessible account. If a recession leads to job losses or unexpected expenses, this cushion can help cover essential costs without relying on credit or selling investments at a loss. Reduce unnecessary expenses and live below your means. Now is the time to evaluate spending habits and cut back on discretionary expenses. This might mean dining out less, canceling unused subscriptions, or delaying large purchases. Living below your means allows you to save more and be better prepared for financial uncertainties. Diversify your investments. A well-balanced investment portfolio can help minimize risk during economic downturns. Diversification means spreading investments across various asset classes, such as stocks, bonds, real estate, and commodities. Defensive stocks, such as those in healthcare, utilities, and consumer staples, tend to perform better during recessions as demand for these products remains steady. Pay down high-interest debt. Credit card debt and variable rate loans can become a financial burden if interest rates rise during a recession. Paying off high-interest debt before a downturn can improve financial stability and reduce overall expenses. Maintain job security and seek additional income streams. Recessions often lead to layoffs and hiring freezes. Strengthening job security by improving skills, networking, and staying adaptable within your industry can help mitigate risks. Additionally, having alternative income streams, such as freelancing, a side business, or passive income sources, can provide extra financial security. Stay invested but rebalance your portfolio. While market downturns can be unsettling, panic selling investments often leads to long-term losses. Instead of pulling out of the market completely, consider rebalancing your portfolio to include more stable assets, such as government bonds, dividend-paying stocks, or index funds that historically recover well after recessions. Stay informed and adapt. Economic conditions change rapidly, and staying informed about market trends, interest rate policies, and global financial news can help you make better financial decisions. Following reliable financial sources and consulting with a financial advisor can provide insights on how to navigate uncertain times effectively. To wrap it up, recessions are an inevitable part of economic cycles, but they don't have to be financially devastating. By recognizing early warning signs and implementing proactive strategies, we can protect our financial well-being and even find opportunities amid economic downturns. What are your thoughts on the potential for a recession? Have you taken any steps to prepare? Share your insights in the comments below, and subscribe for more videos on in-depth financial strategies.